The stock market is a projecting tool, right? And it has very quickly off the bottom, as we're talking about today, as you all have talked about today, in a very short period of time, I think it's been 102 days today, sharply recovered. It saw that all of the weakness that we saw from the virus, from the pandemic, could be recoverable. And so more quickly than I personally thought, more quickly than most investors thought. It saw that and it took advantage of it very, very quickly.
Hey, Ann, good morning. Say you're an individual investor and you've done what a lot of the pros say you should do, which is put a decent amount straight into the S&P 500. Now, with these record highs, how do you protect yourself from here?
I think you do have to diversify, and that's what our portfolio managers have been focused on, is building strong portfolios that can withstand anything that comes in the future, right? So although we do like technology, we have been overweight that space for a very long time, our portfolio managers saw opportunities across the broader spectrum. So they were early to go into the industrial space, the material space, and they have stayed away from energy. They have been underweight the bank space. And so I think investors have to be careful about the areas they invest in. There's certainly a lot of risk, and equity investing is all about risk versus reward. We also know there's been a lot of secular change happening, right? And we want to be on the right side of that secular change.
But from equities in general, do you protect yourself with more equities? I mean, is that what diversification more broadly means now?
It's interesting because there hasn't been any place to get yield. Investors have come to the equity market seeking that yield. And that isn't necessarily the safest way historically to play it, but it's like the nicest home on the block when it comes to finding returns. And at some point, that will create more risk for all investors. But at this point, it's interesting. When you look at the S&P 500, the multiple, I think the average multiple is around 22 times. The top 5 stocks in the S&P actually are trading at a 12 times higher, right? So, or 12 multiple points higher. So 32 times for the top 5 stocks, and where the bottom 495 stocks are trading at 20 times. And so there are stocks in that bottom 495 and certainly outside of the S&P 500 that are attractive. When you look at the small cap indices, they broke the June highs last week. And so there are other places in the market to invest, and our portfolio managers are looking across the spectrum.